Anyway, thank you everyone for coming for this inaugural Sinclair Wilson Financial Roadshow. For those that don't know, my name's John Miles. I'm the resident partner here in Mount Gambier. And yes, just a little word about Sinclair Wilson, just so people can understand. We've been over the southwest Victoria and southeast South Australia an active and dominant provider of professional and financial services in the region overall for about 70 years. As well as general taxation, accounting and audit services, we have specialist services in 5 permanent offices and a few other regional offices, total around about 130 people. The offices are Mount Gambier, Hamilton, Warrnambool, Camperdown and Colac, and some of the other services that we provide are succession planning, business advisory, integrated business solutions and applications now, human resources consulting, superannuation, which is a very big and topical area, financial planning, and also we have a regional Morgan stockbroking branch which is a very useful service for people just to have that ability to talk to a local stockbroker. However, we're always keen to invest and look at new opportunities and business trends, and indeed we're trying to continue to learn and develop ourselves just as we seek to assist our clients and fellow citizens to do the same. We have a very deep feel for the local region and its economic drivers, but also strive to stay abreast of and share what is happening further afield and around the corner. Hence the Financial Roadshow tonight, hence the excellent stable of external speakers we've got here tonight, and also some of our own internal staff are going to speak a little too. And we thank them for their time and input today. Our internal speakers will also be here and they will continue to reinforce our servicing of the financial applications and try and give you some of the business insights tonight. So we hope you get quite a bit out of today, and on that we would like to encourage some interaction. So don't hesitate if you've got any questions, raise any issues, and I and the speakers will try and answer them when time allows. Finally, just a couple of housekeeping issues. First up, we've got John Pegler coming to impart his wisdom on Centrelink and related issues. John is our financial planner in the Mount Gambier office. He has quite a bit of experience dealing with Centrelink, and it's becoming an increasingly complex area, and especially the aged care side of it. So we've just asked John to come along tonight to give us a few pieces of insight, especially how it can impact with businesses. There are some traps when you're not aware of what the implications can be. So I will let John come up here and present to you. Thank you.
I guess the reason for me speaking about all things Centrelink is the difficulty in accessing information on aged care issues and on also general pension issues and youth allowance and the like. So quite often we come across situations where people perhaps have not had good advice, and it's very difficult to undo something that could have had a much better outcome. So we play a fairly significant role in trying to tie everything together. And certainly from a planning perspective, we do look at the whole family unit. So it may be a matter of looking at the generation below and just looking at their options to get youth allowance if they're going away to study, and also looking perhaps at the grandparents and whether there's issues that we need to look at with aged care. So it's a fairly complex area and becoming more and more difficult to get information out of Centrelink. So it's very difficult to sort of compress information into a half-hour slot. that we've got a couple of case studies that I'll look at just to give you a bit of food for thought. So firstly, just some numbers on what's out there. So pensions, firstly, that for a couple, 35,000 roughly per annum, and single about 24. So a reasonable level of income, not probably enough to live on, but certainly a start. And probably the big thing that we see these days are the assets test cutouts, and for a couple at 837,000 for a homeowner couple, and for a single person 556,000. So if you're a non-homeowner, those limits are about 200,000 more, and it's really the assets test is the problem that we find with the pensions side of things. So income generally not too bad. A couple can be just under 79,000 and still get a bit of part pension. But assets test is the big issue, and I guess everything pretty much that a person owns, bar their principal residence, is assessed. So it doesn't take a lot to get you up to being impacted, and not a lot to cut you out. So the first thing is just to look at a bit of a case study of more of a succession issue. So in this case, we've got a person who is widowed, and Hillary, and she's getting a full rate pension at the moment. She has a fairly modest house, so 600,000, and 150,000 of financial assets, so shares and cash, and car and household contents at 50,000. So at the moment she's getting a full pension and living on that at the present point in time. So now in this particular case, she has two children, adult children, Donald and Melanie, and Donald was previously provided for by her late husband's will. So he was a bit of an agitator and was keen to get assets early in the piece, and her husband actually left him a significant amount of property in that will, so 800 odd thousand. They had a larger asset base and have been living off that, and assets have slowly eroded over time. So the intent was always for the residual assets to go to Melanie, and those assets have dropped down a bit in value. So in this case, Hillary's concerned that I guess Melanie gets her fair share of assets. So Donald has been chasing fast cars and fast women. He sold the property not long after he inherited it, and has done a pretty good job at blowing the asset that he received. So, and I guess the concern in the family unit is that he may come back for a second bite. So now, in this particular case, Hillary's spoken to Centrelink, and she's been looking at whether she should gift that house to her daughter now. So Centrelink have correctly advised her that if she does that she'll lose her pension for the next 5 years. So the gifted asset, bar 10,000, will be maintained as an asset for the next 5 years. That, combined with existing financial assets, will preclude her from getting any pension. And this is fairly typical, I guess, that someone might ring up Centrelink and ask a question and they'll get an appropriate answer, but it may not, there may be other options, and that's what's not coming out of the Centrelink system at the present point in time. So she's still concerned and seeks our advice about what she may do. And this is just one option that's out there for her, is to actually transfer the house now and retain a right to live in that house for life. And there's no right or wrong with these things. It's a matter of looking at each family unit and what might best suit them. There's a reasonableness test that always gets me, that looks at the life expectancy of the individual and multiplies that out with a married rate of pension. So in this particular case, it would be possible for her to give roughly 641,000 of assets, including the house, to her daughter, retain a right to live in that house for life, and not suffer any pension detriment. So there's considerations there, and first and foremost that the person should have legal advice on the matter. There's certainly potential that if the daughter has a matrimonial breakdown, that there could be implications there, and stamp duty. I guess in this particular case, if the mother was building a house in town or something like that, that might be the time to actually do it, just to avoid any stamp duty issues. But most certainly it's something that presents some options in this particular case, but it certainly needs a bit of quality advice to go with it, and just to, I guess, cover all aspects. The next one is just looking at farming couples, and I appreciate that there's not too many people with rural backgrounds in the room, but you may well have parents that fall into that bracket. So we've got an aged couple, Tom and Jill, living on the edge of town, 2 titles, and they just want to see out their years, basically living close to town. The property's gone up in value over time. It was never a terribly productive farm, but they certainly raised their family and everything on it, and are happy living where they're living. So there's 2 titles, house and land, which they've held for more than 20 years, with a value of $2 million, and that's leased out to the son. And a second title with a value of $500,000, and that is leased out with an income of about $10,000 per annum. They've also got a few other assets, some shares with a net income of $21,000 off those shares, with the franking credits refunded. That's provided Bill Shorten doesn't take them away. So at the present point in time, they've got a disposable income or living on $56,000 per annum, and they're just getting by. And I guess most married couples would need at least $60,000 a year to live on. So in this case, they're, I guess, just getting by, not saving anything, but not going backwards. So now, a few concerns that they've got. Firstly, that their son worked unpaid on the farm for 10 years and needs to be compensated ahead of his siblings. The second is that the husband's health is not fantastic, and the kids have got onto the My Aged Care website and done some calculations based on the current asset holdings, just to see how they would shape up from an aged care fee perspective. So in this particular case, based on that asset and income pool, the likely fees that they've come up with are a basic daily care fee of $18,000 per annum, and that's a fee that everyone pays, so no avoiding that one at all. Then we've got a means tested care fee, and that is just under $23,000 based on that asset pool. So that particular fee has a cap of just under $27,000 per annum, and a lifetime cap in the $65,000 range. So it is something that doesn't go on forever, but it certainly requires a significant cash flow to fund it. So in this particular case, without looking at any accommodation deposit or bond or the like, we've got a cash flow issue basically. So we've got outgoings of roughly $41,000, and then on top of that, the aged care facility, based on the assets, may well ask for an accommodation deposit. And in this area, they typically sort of run in that $350,000 to $450,000 mark, just depending on which aged care facility you're looking at and the quality of the room. So a single room with an ensuite would typically be around that $400,000 mark. So now you've got 2 choices: is to come up with that accommodation deposit with, in this case, $400,000, or pay equivalent to an interest on that, and the current interest rate is 5.72%, so another $23,000 on top of the existing fees. So as you can see, aged care can be a fairly expensive subject to get involved with. So, and in this particular case, cash flow is an issue. They don't want to sell the farm. They want the part of the property perhaps to go to their son, and the rest to be form part of their estate. So there's a couple of options, and this is where I guess seeking advice can give some good value basically. So in this case, when we look at this particular farming structure, that they've been on that the title that the house is on for more than 20 years, so we can get that whole title exempted from a Centrelink assets test perspective. And even if that property had a value of $5 million, if there was just one title, potentially they could receive pension. they'd really like to stay in the property, enjoy that assets test exemption, and the other thing is that this exemption also applies to the aged care fees. So first solution is to apply for exemption on that title and continue to receive the lease income from their son. The second title, which is $500,000, may be transferred to the son using foregone wages provisions. So in the rural sector, we have I guess, many cases, probably becoming less and less as time gets on, but many cases where children have worked on farm and have either not been paid or paid a fairly low wage. So there is a capacity there to, I guess, compensate the person that's transferring the land. So the calculation uses average weekly ordinary time earnings, which are around that $80,000 mark, less a value for keep and a notional tax liability. So the deductible amount where no wages are paid comes up at roughly $58,000 per annum. So in this case, it would have been possible to transfer land to the son without any Centrelink detriment up to about $582,000. So what we're able to do in this case is transfer that title. It gives the son some security and no detriment from a Centrelink perspective. So the outcome in this particular case is that the son's toil has been provided for. From a Centrelink assessment perspective, we've got the only remaining assets are perhaps household contents and car at $50,000. Shares with a reasonable income coming off them, lease income of $25,000, and with those two levels of income and a modest level of assets, the couple would receive about $23,000 in pension. So their disposable income or gross income is certainly up by roughly $13,000 per annum on where they were in the first place, and associated concessions and that sort of stuff. So in this particular case, the aged care position would be much more favourable as well. So we've significantly reduced the assets, and income is certainly up a bit, but it would be a much more affordable situation. So that's just a very brief overview on the pension and aged care side of things. We also, I guess, when looking at family units, we do look at one of the big or most expensive issues for people living in country areas is sending kids away to uni. So it is something that we do get a lot of queries on. We do see cases where things could have been done differently and given a much better outcome, basically. So we'll just have a very brief look at dependent youth allowance, at how that's assessed, and also at independent youth allowance. And the two subjects here are Gambier students, which is probably the one that we most commonly deal with, and fully independent students. So what's on offer? Firstly, I'll just briefly run through this. The rates, perhaps the one that's looked at most commonly is for a child that's over 18 and living away from home. So the base youth allowance is about $11,600 per annum. Now on top of that, they can generally qualify for rent assistance, which is up to $3,500 per annum. And most residential facilities structure the rent component of what you pay them to conveniently satisfy the, I guess, minimum criteria to get the maximum rent assistance. So that tends to be, if we look at any residential facilities on campus, that they will have it structured that way. So on top of that, start-up loans, we don't really get any inquiry on them because they have to be repaid. And probably the big one that is a significant carrot as a non-taxable payment is for children that are getting dependent youth allowance, is a relocation scholarship. So that's roughly $4,500 in year one, $2,200 year 2 and 3, and then just over $1,000 in subsequent years. And if the child or student only gets $2 a fortnight in youth allowance, they'll still pick up the relocation scholarship. So that on its own, and perhaps rent assistance, may be a significant contributor to the family income. So looking at what potentially is available is just under 20,000 in total payments per annum. So it's a fairly attractive carrot if we can manage things to qualify for it. And in a lot of cases, this is a difference between going to uni and not, basically, just depending on how tight the family finances are. So the important thing to get your head around is what financial year's income is looked at. And in this, or in any case, the financial year before the calendar year of uni is what's looked at. So if you had a student that was going to uni next year, then the current financial year, ending June 18, is what's looked at as far as parental income goes. Income is taxable income plus a couple of add-ins. Probably the three more common ones that we see are fringe benefits, so if you've got a vehicle with your job or something like that. Investment losses, if you've got a rental property that's running at a loss and being offset. And reportable super, so salary sacrifice, or if you're self-employed, any deducted contributions that are put into super. So that's added on to the actual taxable income for the year, and so we need to be mindful of those things. So the maximum rate of youth allowance is reduced by a fifth of the parental income over the free area, which is roughly 53,000. And then that reduction is apportioned between dependents. So if you've got twins going to uni, then the reduction is apportioned between the two. So in the example I've got there, parental income is $10,000 over the impact level. So there's a rate reduction there of $2,000 per annum. And again, if there were twins, that would be $1,000 each. So they'd both be fairly close to getting maximum rate youth allowance in that example. So it's the more kids the merrier in this particular case, or more dependent children. Gap year students, this is probably the most common area that we get queries on, and this really covers students that are moving away to study, and they don't necessarily have to be going to a major to a capital city. It might be to Geelong or Ballarat or places like that. So the main requirement is that they're coming from a inner or outer regional area, which includes Mount Gambier, Warrnambool and the likes, and that they're moving away to study. Now, in this particular case, they've got to earn 75% of the national training wage, and historically that had to be within 18 months of ceasing study or finishing up at school, and that was reduced in January to 14 months. So that training wage is about 33,000 per annum, so they've got to earn roughly 25,000 in that period since they finished school. Now, I guess where we see a few people come unstuck with that is that they will have a gap year, presume that they're going to earn that level of income, but a lot of traineeships really run at 21, 22,000, those sort of numbers. So it may be necessary for them to, if they're starting a traineeship in January, to do some work in fast food industry or the like in that November, December period. And similarly, if that job finishes up in January of the following year, they may need to do some more work after that to get them over that 24,836 figure. So it's, I guess, a bit sad when we see someone that's done the hard yards and has come up and earned 24,000 or something like that and just fall shy of the required income. So it's something to be monitored, and there's, you know, I guess some traineeships might run for a 12-month period, but that might be 11 months of work and 1 month of annual leave, or they might be for 12 months and then have annual leave paid out on termination. So you really need to know what's going to go on at the start, just to determine whether other work needs to be done. Now, the other trap with this one that people are often not aware of, they think that I've done my gap year, I've earned the 25,000, I'm going to be independent, is that it still looks at parental income for the first year. So, and parents' income needs to be below 150,000 in the first year of assessment. So if you had a student that was, or potential student that was doing a gap year at the moment, and were going to go to uni next year, they're comfortably going to earn 25,000 in the current period, then you need to make sure that your income is below 150. And there's a few things that can or do bring people unstuck here, and that might be where they've perhaps sold a rental property and had a capital gain, sold some shares and had some capital gain, and or I guess probably the more unfortunate one is where they've perhaps changed jobs and they've been made redundant, taken a lower paying job and had a bit of leave paid out on termination, and that may just tip them over the edge. So fully independent youth allowance, and this is the hard one to qualify for, and this really covers having to work for an 18-month period. That can be broken up, and it's got to be an average full-time employment really is defined as 30 hours a week. And we can have 6 13-week blocks of 390 hours. Now, the big issue with that is that if you left school, if you're working on this, if parents' income was over 150,000 and you wanted to aim at qualifying with this criteria, is that if you finished up at school in November of 17, then the last 2 13-week blocks will end in mid-February 19 and May 19. Bearing in mind that most students are looking at O week in about that middle of February, and so we do have problems with trying to meet these criteria. If the parents are self-employed, or I guess there's a bit of scope there to perhaps employ them through the business, and sometimes that can be done remotely, but the big issue or the big carrot with this is that the parental income doesn't apply. So tough test to meet, but it is possible. A couple of considerations. Primary producers, there may be scope to use farm management deposits, and when we look at the income test for these payments, that deducted super contributions are added back in. However, farm management deposits aren't, and so for the period of study or during this year where we're trying to get the income below 150,000, it may well be a better strategy to use farm management deposits rather than deductible super contributions. For commercial entities, if you're trading pretty close to that 150,000 mark, then a few things that you can plan through with your accountant, and that might be bringing forward some expense or deferring income. The next one is trust distributions, and just something to be very aware of, and again it's an area that we do quite a bit of planning with and is not well understood, in that the Centrelink assessment of trust distributions is quite contrary to what you might actually think. And to give you some perspective on that if you were perhaps making some trust distributions to a child in this current financial year, and we're not doing your tax perhaps till April of 19, that trust distribution to the child will impact from April 19 to April 20. And so we've got to have a clear look forward at what's likely to be going on in that child's life at that point in time. So it is a bit of a trap, or can be a bit of a trap, and so we need to be very conscious of forward planning for anyone that's running income through trust structures. Liquid asset waiting period, another one that brings people unstuck. So the student, if they've got more than $5,500 cash at bank, which they're most likely to have if they've had a gap year, or hopefully they have, then they will also be subject to a liquid asset waiting period. That waiting period at the present point in time is up to 13 weeks and is being extended to 26 weeks as of September of this year. I guess people tend to work around that in different ways. Often they'll have a bank account in mum's name that the student might access, or they might pay a fairly hefty level of board or something like that while they're working, but it is something to be very mindful of, because if you go through and have a gap year and do the hard yards and turn up to Centrelink in February thinking that you're going to qualify straight away, then they may well tell you that we'll pay you from the end of May. Personal income test for students. and this is probably the one thing that is reasonably bright on the horizon, that students can actually earn a fair bit of money without impacting on their youth allowance. So that threshold at the moment is $437 a fortnight, and they can build up an income bank, and this is really allowing them to do significant work in the holidays and that sort of stuff without any detriment to their youth allowance. So that bank is up to just under 11,000 per annum. So it's quite possible that they can earn, roughly $10,000 per annum and still get maximum rate youth allowance. So, and probably the one thing with these is, and we've really got to drum this into kids that are leaving school and that sort of stuff, that we hear all the time, well, I'll get a job after the holidays, and it's not really a successful option, basically, and that they really need to hit the ground running and have a job really on day one. So that's just a very brief overview of a number of issues that we look at. I'm happy to take any questions now if anyone has any that they'd like to raise.